Welcome everyone to today's first episode of the Untold. And as this is the 14th of February, happy Valentine's Day to everyone. My name is Giacomo Greci, and I'm the president of the international association called the CSRT Auditor. We choose today for the first episode of this series to celebrate somewhat the love and the passion we have as myself and in the association for the sustainability, for reporting, and because we know sustainability is about the love for the environment, the love for the others, the love for the future will come after us. So that's the better. What's the better day than today to start this series? So if you are here, it means that you care about the sustainability reporting, but not just any reporting, but the one that truly holds up under the scrutiny. Whether you are a sustainability professional, an auditor, or a business leader which are struggling or navigating through ESG compliance, this session is for you. Today, we are tackling a question that is shaping the future of corporate transparency, the limited versus the reasonable assurance. But what's the real difference? How does it impact sustainability audits? Before we start, let me ask everyone something. Have you ever looked at the company's sustainability report and thought, can I actually trust this data? That's exactly why the sustainability assurance exists and why the CSRD directive is asking for, to ensure that the ESG reports aren't just the marketing brochures, and not even the company profile, but the credible, verifiable, and decision useful reports for investors, regulators, and all stakeholders out there. But here is where the things get tricky. Not all assurance is equal. You may have seen terms like the limited assurance and reasonable assurance, but what do they actually mean in practice? But more important, how does the level of the assurance change the depth of the audit procedure, the credibility of reports, and the way that the business are perceived between the two types of assurance? That's exactly what we will talk about today. But let me clear, this isn't just another dry talk on auditing principle. We are here to get practical. I try to give everyone some real-world example, some behind the scenes into the assurance procedure, and a clear roadmap on when and why company may need to move from a limited to a reasonable assurance. I want this to be interactive, so drop any question in the chat at any time. You have a QR code in upper corner, which you can scan and you can fill up a form with your question, and we try to answer at the end. We already had some questions that arrived that we'll answer after we introduce all the topic of today. If you're just listening, don't worry. We have ready some key insight that will change how you think about the ESG verification. So let's get started. First question, what's the main procedural differences between the limited and the reasonable assurance? At the bottom level, the fundamental difference is the depth of and the extent of the testing. On the limited assurance, we rely on inquiry, analytical procedure, limited substantive testing, and this is the key word for the limited assurance, to conclude that nothing has come to our attention to indicate material misstatement. On the limited assurance, the auditor on the assurance letter, they give a conclusion. What does it mean? Based on what we have seen, based on the type of control we did and the documentation that we came to our attention, nothing indicate to us that there could be some material misstatement. Here, material, we are not referring to double materiality or material topic. Material is a terms which is used for the in audit that it's like the threshold which something that we can find an error, it's irrelevant or not. But we'll go deeper on this on one of the next episodes that on this series. On the other hand, on the reasonable assurance involves detailed testing, verification, a more deeper risk assessment to provide a positive or negative, and this is the other keyword for the reasonable assurance, an opinion on whether the sustainability report is free from material misstatement and so on. So from all the procedure that we are taking in place, we must have an opinion, positive or negative. But, and this is very important to understand, having a reasonable assurance, it's not equal that the sustainability report is exempt of any error, but just that the risk is at a low level. But what's this, the risk? What is this material misstatement? Let's say this, the error is relevant if the stakeholder or the reader of the sustainability report, if the error were not present, he would have another opinion on the sustainability report, which is reading about the company. So this is when we, this is this, what's material misstatement it's all about. So it's not about what is tested, but how deeply it's tested. It's the level of the evidence that if we collect and we evaluate the change from a limited to a reasonable assurance. So let's now talk about the procedural differences, how the testing changes between the two. On the limited assurance, the auditors focus on broad checks rather than the deep verification. The key procedure include inquiry with the management and the key function of the organization. For example, I would ask the sustainability officer how they calculate the carbon footprint, but I'm not going the limited assurance to verify the data source directly. It's just based, okay, tell me how you calculate the step that you did, and it's like on the limited assurance, we are going to check the process. If the process is correct, the outcome can be the same. But we are not going to do any other specific procedure to verifying the data source directly, which is more for the reasonable assurance. We do also some analytical procedure. We are comparing sustainability KPIs, for example, to what the company have reported on the previous year, or just by looking at some industry benchmarks. For example, if an energy company reports that they have dropped the emission of 25%, we just check if this aligns with their production volumes. We rely also of internal documentation. We review them, like the ESG policies, the procedure that they have written, taking place, and the framework they use for reporting. We do also some site visit, but it's limited. It's, let's say, for example, that we have an organization with multiple factory, with multiple site. We just going to visit only a single factory. Usually it's the main one, instead of going through every factory that or the sites that the organization have. If we look at the reasonable assurance, it follows more robust procedure. For example, a more detailed substantive testing. We are going to verify the accuracy of sustainability KPIs. By what? By tracing numbers to their original records. For example, we are going to check the energy consumption invoices instead of relying on the report or the Excel sheet that the sustainability officer gave to us. And we are also doing recalculation. So we just check deeply of how the data was managed to get the result of what is reported on the report. We also go much deeper into internal control testing. This is also a topic that we will talk in another episode. But for now, let's assume that we are we assess that the internal controls are designed, are working effectively, and we are going to check also the data collection workflows and if it works. For example, by injecting some fake data to see what the internal control respond. We do also more extended site visit, like I said for the limited assurance. Here we are going to check also multiple operation site. Let's take, for example, a company that claims in their sustainability report it's zero waste in production. We are going to physically inspect the waste disposal processes on multiple sites that the company have. Otherwise, you go on the main site which shows clean and shine, but on the others there will be some problem. We rely also on third-party confirmation. This is something that we are very well aware and we are using for the audit on financial report. And this is the same that we are going to use if the company used some third-party data, for example, from the supply chain, into the sustainability report. What we do, we just send a letter saying that to confirm that the data that they use in the sustainability report is the same that they sent or they were asked for. Or, for example, if the company say that they are buying energy only from renewable energy from their supply, we are going to check if the certificate that they gave to us it's correct or not directly with the confirmation from the issuing body. So, in the reasonable assurance, everything is proven. We must prove the accuracy. On the limited assurance, we check for consistency. We look for anomalies that will lead to us to a more deeper check or control or not. But the next topic is when a practitioner switches from a limited to reasonable assurance. This is something very interesting because looking at few comments on LinkedIn network, I see that the advisor are getting maybe surprised for what the auditor are asking to them. Because they say, why on the limited assurance you cannot ask this or whatever. In fact, auditor have a sort of freedom. He can change from a limited to reasonable assurance for maybe some specific disclosure, or they are more asking for documentation just to be sure of what is written on the report. Apart from all the general reason like client request an upgrade, maybe they started initially with the limited assurance engagement, they want a more higher credibility, or because it's requested by investor or financial institution, they want to have a reasonable assurance, then we can upgrade the type of audit, or maybe can change some regularity like the CSRD. The CSRD, as we know, mandates the limited assurance until 2026 and in 2028 we go for the reasonable assurance. But what is more important to understand now, it's about what we call the red flags identification. If we found some inconsistencies, some anomalies, some potential fraud, auditors may escalate the procedure. For example, if we find a company which is reporting a zero water waste, but the records show there's some missing data from the suppliers, this is something that we may upgrade our type of control to a reasonable assurance and not a limited assurance. So we can vary, we can change for some specific disclosure or for everything. From what I've seen, as we are like on year zero. Everyone, auditor and the company are facing the challenge of the CSRD and the sustainability report under the ESRS principle. And it's just like a little fear of things are getting be good and correct and so on. So it's I say the auditor is the sparring partner of the company. We work all together, try to give all the best possible to our reader, which is the stakeholder on the final stage. So changes from a limited to a reasonable involves a more direct testing, so some substantive procedure. We expanding the sample size for the document verification. We are going to do a more rigorous interview with the process owner. I always say to my colleague, we need to talk with the people, because talking with the people or the key people inside the company can give us a lot of information that we need to have our opinion on limited assurance. And on the passing, going from the limited to a reasonable, we have a more stronger third-party confirmation. So before getting into the question, let's have some practical example of testing in both engagement. If a company reports carbon neutrality, how will the testing differ from a limited to reasonable? On limited, like I said before, we inquiry the management, the sustainability officer, the key people which did the calculation, and we ask how to calculate the carbon emission. They may give us the Excel sheet or the report. We just review the carbon calculation methodology. We are going maybe to compare the emission figures with the previous years if they already did. So we don't have, maybe if there are some big changes, then we go deeper about the changes more on the low side or the high side. If these go into the reasonable assurance, like I said, we recalculate the emission using the raw data. We are going to get all the invoices, all the data they used from their source, and then we are going to check, recalculate everything from there. And if we, for example, go into the social impact metrics, like the workforce diversity, on the limited assurance, we review the HR reports on employee diversity. We check the alignment with the past disclosure, if we have any. And we interview the HR manager, trying to understand how they collect the data. And on the reasonable assurance, on the other hand, we are going to do this that we do on limited assurance, but more, we are going to verify the individual employment records. We recalculate the diversity statistics from the raw HR data. We test the company hiring practices just to check for their policy compliance. So, in limited assurance, it's like we trust what you did, what you wrote, but we need to verify even lightly. This is the base of the professional skepticism. While in reasonable assurance, we audit everything to the source. It's the depth of the evidence and the testing that differentiates the two. So, I try to cover the main topics of the differences between the limited and the reasonable assurance. But let's get to some question just to see what we received. Okay. The first one, what are the key factors that determine whether an engagement should be limited or reasonable assurance? Well, I say something about this, as can be some regulatory requirements, the stakeholder expectation, the risk assessment. Maybe the company operates in a high-risk industry, and they are required to have a more deeper audit than the one from the limited assurance. The maturity of sustainability data collection, I can say. If the company have already a strong process for data collection of sustainability data, maybe they may ask for a reasonable assurance instead of the limited. Can a sustainability assurance engagement be both limited and reasonable assurance at the same time? Yes. Some engagement are hybrid. We have a certain disclosure like the GHG emission, which undergo the reasonable assurance, while others, for example, the supply chain ESG metrics, are only subject to a limited assurance. So I can say that it's more a mixed approach between the two that will often happen when we are on the limited assurance. What are the main risks that auditor look for a limited assurance engagement? I can say, okay, as an auditor, we focus on more on the qualitative part of the report rather than the quantitative part of the report because it changes the risk factors. For example, we are going to check inconsistencies in reporting. If a company reports a net zero emission, but they don't have anything like a budget, a strategy, investment, or whatever, how they can achieve those net zero emission. We're going to check the documentation underlying what the qualitative information that they have on the sustainability report. Or maybe some unusual change in ESG data, some maybe the emission or the employee diversity percentage, it's drastically changed without any explanation. Or some gaps in reporting framework compliance. For example, some missing disclosure on the ESRS. So if any red flags arise, some additional procedure we need to maybe necessary to be put in place. What is the most common reason for upgrading from limited to reasonable assurance? Like we said, some investor pressure, the change of the regulatory, like I said a few seconds ago, if we found some material misstatement detected in the limited assurance, we need to increase the testing depth, and then we sort of work with the reasonable assurance than the limited assurance. Can a company transition directly to reasonable assurance without going through limited assurance first? Yes, it can be possible. We need to see and to check how we can change the engagement that the company give to auditor, but yeah, it can be possible. We can start with the limited assurance, and then we can upgrade to a reasonable assurance. How does site verification differ between limited and reasonable assurance? On the limited assurance, few or no site visit, unless we find some risky issues that we think that it's better that to have a more frequent check on the site visit. Interview with the management, and we can just do a data review relying on what the organization provide us as for documentation. On the reasonable assurance, we do on-site verification on multiple locations. We have an on-site visit lead us as an auditor to have a direct observation of the ESG practices, like checking the waste disposal, review the working condition, the health and safety, and so on. Direct observation for me is essential to have a better understanding and a better idea of what the company is doing. What are examples of tests that are exclusive to reasonable assurance? Recalculation, third-party confirmation, some starting testing, which are the tracing ESG data back to the original source. What is the most common misconceptions about sustainability assurance? Well, I said something about this before. The most misconception is about the people think that the reasonable assurance is equal to 100% accuracy of a sustainability report. This is not. It's all about lowering the risk of the material misstatement. But it's even reasonable, it's not a guarantee that everything is correct. Because in the end, it's not about if an error is in place, but if that error can change the opinion of the stakeholder that is reading the report. This is our the final one which we need to take care of. So it's all about professional judgment and the evidence collection. What are the most frequent challenges in conducting sustainability assurance? I can say the biggest one are the lack of standardized data, the difficulties in measuring ESG impacts. Complex value chain is another one which increase the difficulties, and more than all, data reliability issues. This is why we spend a lot of time to check the internal control system, because if it's in place, if it works, if there are enough separation of duties, I think we can be sure that the data, once they go into the process of the company, we can trust those data. This is funny. How will sustainability assurance evolve in the next 5 years? I think that we need to survive the first year, and then the second year, and then we will think what will come up next. But I can say that AI will enhance all the ESG data verification, also for data collection. So this will help us to check, to understand, and to trust more all the data that the company will have used on their sustainability report. How long does a limited assurance engagement typically take compared to reasonable assurance? It depends. It's difficult to say nowadays how long it takes one instead of the others. Of course, on the reasonable assurance will will take a lot of time, more time than the limited assurance one. But it's going throughout the year, because usually you can have the engagement on April or of June, and you start by reviewing something like the double materiality assessment, the stakeholder mapping, the value chain mapping, and then going near the end of the year, you're just going to check the process of data collection, the data collected, and until you have the first draft of the sustainability report. So it can take maybe 6 weeks, 10 weeks throughout the year or more. It depends also of how many material topics the organization have, because for each material topic there are some checking, testing for each one, which it depends. But maybe we can go on this range. On the reasonable assurance, at least the double of the time. Can a company downgrade from reasonable assurance to limited assurance? Yes and no. Actually, if there are some regulatory changes, then you can downgrade. But once you give the auditor a reasonable assurance engagement for example, 2026, for me, you cannot change the type of assurance until the year after. But if, as an auditor, we receive the request to downgrade from reasonable to limited, and there are not any regulatory change or whatever, this is a red flag that we need to take care, because as we say on the limited assurance, the level of the testing it's much lower than the reasonable, and these red flags indicate that the company may hide something, which we will find if we are going to do the reasonable assurance testing. So be aware of this. The common misstatement found in sustainability assurance engagement. The best one, it's an evergreen, because company tend to write only on their positive impact, and they tend to hide their negative impacts by omission or ignoring the negative ones. Or data inconsistencies, it's some mismatching for example, the carbon emission across different sections of the report, or the errors in GHG calculations, and also inconsistencies between part of the sustainability report, because once you do your sustainability report, you are going to have a lot of revision. You can change one part of the report and then change after another part of the report. And sometimes there are missing the change from one part and don't reflect on the other part. So this is something that we, at the end, once we do all our tests, and when we have the final sustainability report, this is something that we will go check everything just for the coherence of everything. Are there specific industries where reasonable assurance is more common? Not that I know of. There are companies that they were asking in 2024 for the reasonable assurance, even if they could ask for only for limited, but there can be sectors like energy, banking, finance, pharmaceutical, can be sectors where they may ask and may want the reasonable assurance one. How do auditors handle qualitative disclosure and sustainability assurance? We said something before on another question, but just to recap, we're going to check the policies, the commitment, we check for plausibility and consistency within the report, but we are not to verify 100% underlying facts. On the reasonable assurance, we are going to check to test the supporting documentation. We go more deeply on this. Some example of high-risk area sustainability assurance. Scope 1 to 3 calculation can be in error. Supply chain transparency, because it's hard to verify the ESG compliance on their supply chain after the tier 1, for example, on tier 2 and tier 3 suppliers. It's difficult already for the tier 1. Go figure for the supplier of the supplier. Water waste reporting, sometimes it happens some misstatement in the reduction target. How do auditors assess ESG risk in a company supply chain? Checking the supply chain is a very challenging one. As an auditor, we can assess the risk by examining the supplier ESG reports, and this is important that our supplier are already doing their sustainability report. We are going to test their certification that the supplier may have. We are going to review the second level audit that the company were doing to their supplier, and we're going to verify their third-party attestation. So for all the data, we just check the confirmation of this. So Let's check now on the other question which arrived. Can you elaborate how the auditors determine the materiality threshold on so many different data points? Answering this question will take at least half a day. I will try to get very short. We have two type of materiality threshold on how to determine the materiality threshold. Okay. There are two type of materiality that we need to set. The one for the quantitative data and the other one for the qualitative data. We don't have for the quantitative data any standard like we have on the financial statement. The financial statement, we take the revenue, we multiply for the percentage and so on, and we arrived at a materiality which we use for everything on the financial report. Here, we have multiple quantitative data. We need to set multiple quantitative materiality threshold for every data. We don't have, like I said, any standard on the sector. So it's all based on what we know, and what we can understand is a priority. What it's more important that for the stakeholder who is reading the report. So for the most important topic like the mission, we may set, for example, a 5% of materiality threshold. So if we found an error that will go over the 5%, the company need to correct this error. For others, maybe company investment into the community, maybe we can lower those materiality threshold because maybe 2% can be enough. It depends on the sector, on the type of organization, and the number and the type of the data points. One fact is for sure, we can't have one materiality threshold for every quantitative data. About the qualitative data, the auditing principles say that we need to consider. It's not about calculating because you calculate something which is immaterial. And it's again, it's up to the auditor to understand if the disclosure can be correct or not, and if there is some error in the disclosure, can change the opinion of the stakeholder. Because on the qualitative data, the stakeholder, it's the most important one that we need to check that this disclosure is correct, because if this is wrong, the stakeholder will change their mind, they change their opinion for the company. This is the most important one. So we just need to consider. For example, if a company reports we have lowered our water usage by 20%, maybe if we are on an area which is a very high risk of water stress, then just the sentence in the report that say that we lowered our water usage, this is the sentence, the disclosure that it's the most important one for the stakeholder, which is based in the area around the company. Otherwise, for the other company, it's okay, you lowered the water usage, but you need to be sure to check this 20% of the reduction. I don't know if I try to simplify in a few seconds about the differences, how we elaborate those materiality threshold. Another one, let me maybe copy and paste for everyone. Okay, this is too long. Do you check the fullness of the data? Example, if the transport emission, the transport for incoming and outgoing products is included and in only part of this information. Do you check whether the emission factors are correct? As someone may see more favorable factors. Um, about the emission, the limited assurance, we are going to check the process. We are going to rely on all the reports that they have for the calculation. Like we said, we are going to check the methodology. If the methodology is correct, yes, someone can say maybe the company can omit some data. Yes, can be possible. It depends if we find something that lead to us to understand if they taken away some data or not. If we have some suspect of it, then we go through a more deeper evaluation, and we are going more on the reasonable assurance than on the limited. So we are going to check all the raw data, do the recalculation from the start to the finish to check if the emission disclosure that they put in sustainability report is correct or not. Okay, let me see if there are some others. I think not. Okay, I think yeah, I think it's all for now. I just want to thank you for everyone for this live streaming of the first episode of the Untold. We will do other episode covering other aspect of the sustainability reporting audit. And today we covered a lot of ground from the key procedural differences between the limited and reasonable assurance to some real-world example of how sustainability audits actually work. If there is one thing that's clear, it's that assurance isn't just a compliance checkbox. It's a game changer for the credibility, for the risk management, and the stakeholder trust. Let's have a little recap for the key takeaways for everyone. Limited assurance is about plausibility. It's focusing on inquiring, on an analytical procedure, on identifying anomalies. The reasonable assurance is, on the other hand, about proof, deep verification, substantive testing, and full validation of ESG data. Company and auditors often start with the limited assurance, but as we understood, the auditor can upgrade to reasonable assurance for some specific topic. In the future, more transparency, more accountability, and more demand for reliable ESG data. If you are a business leader or an auditor, this is your wake-up call. Start strengthening your sustainability reporting process now, before the regulatory pressure escalates, and maybe you will have much more difficulties than now. If you are an auditor, the demand for the sustainability assurance expertise is only going up. This is the time to upskill and lead the way, because I said a lot of time, to be a good auditor, we need to understand what we're talking about. It's not about the completeness of the knowledge, because we will talk on another episode, we will talk about the use of the expert. If we don't understand or we don't know something, for example, the mission, we will have in our audit team an expert of this. But we need to have a general overview of the disclosure that is required by the CSRD and the ESRS. So, before we wrap up, here is your action step. If today's session gave you a new perspective, hit that like button. It will really help us. And if you have a question or want a deep dive on a specific topic, drop a comment or send us an email or a message through LinkedIn. Let's keep the conversation going because it benefits everyone. And we try to answer all the questions that may arise, and it's an evolving knowledge for everyone. And if you find this useful, please share this session with your network because transparency, sustainability benefits everyone. Thank you for being part of this conversation. Stay curious, stay informed, and keep pushing for the better sustainability reporting. Until next time, take care and see you soon.